Occidental Petroleum might be Warren Buffett's favorite stock right now. Of course, I would just be speculating based on recent price action and purchase behavior from Warren Buffett's Berkshire Hathaway portfolio, but I don't think that would be an unreasonable conclusion to arrive at. But what about for you and me? Is Occidental Petroleum stock a buy? I'm going to answer that question in this video, looking at the company's revenue growth, its cash flow, its profit margins, and then comparing it against its valuation, looking at two different valuation methods, the forward price to earnings ratio and a discounted cash flow model for my value of Occidental Petroleum stock, to see if this business is a buy for everyday investors like you and me. Let's get started. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. Looking at Occidental Petroleum's revenue growth over the previous decade on a trailing 12-month period, we see what we typically see with oil and gas companies, and that is volatility. When oil prices go up, oil and gas companies' revenues increase, and when oil prices go down, you see the opposite impact. And we see a similar trend here with Occidental Petroleum. When oil prices crashed during the early stages of the pandemic in 2020, I remember I was able to fill up a tank of gas at about $2 a gallon, $2.20 a gallon back in 2020. Those were prices I hadn't seen in a very long time. Nowadays, prices are back up $4, $5 a gallon. Of course, I live in California, Los Angeles, which has some of the highest gas prices of anywhere in the United States. But you see that when the prices came down, Occidental Petroleum's revenue went down. And then, of course, you had the Russian invasion of Ukraine that sent oil prices soaring, and revenue for Occidental Petroleum benefited as a result. And then you had the reversal when oil prices came back down, and revenue is now back at $27 billion for the trailing 12-month period. And it's still higher than where it was in 2017, 2016, because there's other factors at play other than just the price. It's not just a one-to-one comparison here it's not a one-to-one correlation for oil price and revenue for Occidental Petroleum. But it does play a role. It plays a factor. And so you're seeing that there with the revenue. Now, longer term, will we continue to see that same kind of cycle play out? Or will we see a different dynamic as the world transitions to renewable energy? Now, that transition has gone very slowly. And the OPEC, the Organization of Petroleum Exporting Countries, they forecast that oil demand will continue growing. Over 100 barrels of oil are consumed every day or a year. According to OPEC forecast, that's expected to continue increasing, even though economies are trying to transition to renewable energy. That transition has gone much slower than expected, and this could be something that Warren Buffett sees in this investment opportunity, while everyone else is expecting the world to just transition completely off of oil and fossil fuels and into renewable energy. Warren Buffett might see something different, might see some kind of combination where we have a small percentage or a bigger percentage of electric vehicles and renewable energy for certain areas, and then we still have fossil fuels for other areas, a kind of team effort here, if you will, between the various energy sources to satisfy all of the world's energy needs, because the world population is growing, developing economies are growing, and you need energy to facilitate that growth. And you can't just go cold turkey and switch instantly to renewable energies. And you're seeing a lot of those difficulties play out, especially here in the United States in the electric vehicle industry, where even with the trillions of dollars of government stimulus that's went into the industry, less than 9 out of 100 are electric, even with those trillions of dollars of stimulus. Now imagine what organic demand would be like if it wasn't for all of that stimulus. And so you can kind of get an understand of the dynamic, the broader dynamic that we're working with, and what Warren Buffett could potentially see in this investment, why he continues to buy this investment hand over fist, despite all forecasts pointing to a renewable energy future. Now, the company's operating margin is volatile, goes up and down as with its revenue. It's high operating leverage, meaning they have a lot of fixed cost, fixed expense. So when revenue goes down, their cost still stays relatively where it was. And so you get that negative operating margin. And then when revenue goes up, the cost still stays where it is, relatively speaking. It might go up a little bit, but then you have that margin, right, where revenue is up here and costs are here. And so you have revenue fluctuating, but costs staying relatively flat. And that's the definition of a business with a lot of operating leverage. The more a business, the more percentage of a business's costs that are fixed, the more operating leverage you have. The more you have a business with variable expense, the less operating leverage you have. The primary example of a business with less operating leverage is Uber. If Uber's revenue declines, its cost also decline, because if you're ordering fewer rides, your driver is not getting paid either. They're paid on a per ride basis. They're not paid salary. So that's a high variable cost, low operating leverage business. Occidental Petroleum is a high fixed cost, high operating leverage business. Which one is better? It depends. I can't sit and say one business model is superior to the other one. It's more of a case by case basis, and it depends how it connects with the other parts of the business model and the business strategy. So the cash flow from operations to sales is much better for Occidental Petroleum at 42%, and this tells me that they have significant non-cash expense, things like depreciation and amortization for some of their equipment, some of their facilities. And so that's what creates that difference between cash flow and operating margin. So now let's look at valuation. The stock is now trading at a forward price to earnings of about 12.5, which is near the lower end of where this stock has traded for going all the way back to 2022. So it's on the lower end of its valuation average. And then if I look at my discounted cash flow model for Occidental Petroleum, it shows me an intrinsic value per share of $52 when the current market price is $51, so relatively fairly priced. And combined with the forward PE of 12.5, all things considered, I would say this is a fairly valued business. I wouldn't say this is expensive. I wouldn't say this is cheap. I would say it's fairly valued. And given the market it's in and given its prospects for the future, I would rate this stock as a hold, not a buy. You might say, wait a minute, how can you rate it as a hold and Warren Buffett thinks it's a buy? Well, there's a number of reasons that can explain that. And the one that I like to highlight most often is that these investors like Warren Buffett and Cathie Wood and others, they have other reasons why they buy stocks. They don't just look at stocks and look at it if it's undervalued or overvalued. They have other reasons why they purchase stocks. For instance, they might buy a stock because they feel that they can influence the company's actions by maybe appointing a couple of members to the board of directors and changing the company's policies in a way that they feel would favor themselves and their other businesses and their other portfolio of businesses. And so that's just one example. I don't want to go on, but there's a lot of factors that go into their decision making that are not relevant for people like you and me. Our scale is much smaller, and so we don't benefit from those advantages that someone like Warren Buffett will benefit from. And so that's why there can be these situations where he might feel like for him, it's a buy hand over fist as much as I can get my hands on. And for someone like me, it's neutral. It's a hold. If I didn't already own an oil stock, which I do, I own ExxonMobil, I might consider it because of the diversification impacts it adds and the de-risking it adds to my portfolio. But I already own ExxonMobil, so I don't want to add another oil and gas stock, an energy stock, at fair value. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.